Welcome to Rev Up Your Business with Hilda Gann. We are now in season 5, and we've changed the name and the focus of the podcast. Rev Up Your Business is the podcast for small to medium-sized business owners, entrepreneurs, and HR professionals. Each week, we share tips, strategies, and trends on how you can build success in your business. I share my expertise as a people-centric leader in work culture and human resources. My guests share their expertise in human resources, marketing, sales, finance, IT, leadership, and the multiple facets that you need to take care of your business. If you love to learn and want to find out how you can rev up your business, join us. Welcome to another episode of Rev Up Your Business. Are you worried about the finances of your company? My guest today is Daryl Ching. Do you want to succeed in securing funds to grow to the next level? Well, today, Daryl is joining me. He has spent 10 years in investment banking and then another 10 years working in an executive role at a small business. This gives Daryl that unique vantage point to bridge the gap between the small businesses and the institutions offering capital on both sides. And as a result, he started up Vistance Capital Advisory to help small and medium-sized businesses to be ready to get the funding they need to grow and succeed. I'm so happy to have Daryl joining me today. He is the managing partner at Vistance Capital Advisory. Thank you for coming today.
Thank you, Hilda, for having me. I'm very excited to be here.
When we talked the other day and you talked about how you really want to help small to medium-sized businesses succeed, and they often don't know enough about their finances to make sure that it looks good enough for investors to say, okay, yes, you've got the loan. So tell us some of the key points that you feel would help us as the small business owner who is thinking, well, what do I need to do to get the funds that I need?
So, Hilda, as a starting point, whenever you approach an investor, the first document they ask for is financial statements, historical financial statements. And I think the issue is a lot of small businesses that I meet have a bookkeeper and they've got an accountant that shows up once a year to do a notice to reader and file their taxes. Now, if you look carefully at a notice to reader disclaimer, it basically says, I did not review anything and I relied 100% on management. So as a result, a lot of accountants don't go through the process to ensure the financial statements are actually accurate. And I think this does a disservice for a lot of small businesses because they get a false sense of security that they have accurate financial statements. Now, when you look at a bookkeeper and you rely on a bookkeeper to do financials, they often can do a lot of simple transactions. So they can issue invoices, they can post expenses. But for a question like, hey, for this particular expense, should I capitalize it because it's R&D and therefore it's got value that with a useful life beyond a year, so therefore I should be putting this on my balance sheet? That's not a question that a bookkeeper will typically ask, and a lot of times it's not a question an accountant will ask at year end.
And oftentimes it's not a question that the business owner even knows to think about, right?
Right. And why is that question important? Well, when I look at your financial statement as an investor, I will flip to your balance sheet. The balance sheet is like a net worth statement. It shows your assets and your liabilities. So if I look at your assets and I see zero, immediately from a book value perspective, you're already undervaluing your business because you're not posting that. So that's an example of a question of something that I make sure is done properly. That, sometimes you need to speak to your accountant and say, listen, I'm presenting these financials to an investor. I want to make sure that they are captured properly from a valuation perspective. And I want to make sure my book value is correct so that when you're buying equipment, when you have research and development, you've invested money in your website or marketing, that's being capitalized and showing value on your balance sheet. And the other big thing that I want to make sure, and as a cautionary tale, is to ensure the shareholder loan is correct. And when I say, so what is that? Well, a lot of business owners use their personal credit cards and personal bank account to fund business expenses. If you're not capturing this as a shareholder loan, then again, you're doing yourself a disservice because these are funds that you are able to eventually pull out of the company and return to yourself tax-free. And if that's not being recorded, then you're not going to be able to take that back out. So again, you present your financials to an investor, and an investor goes, "Okay, I see the company owes you 50,000." You go, "No, no, no, no. I put in at least 200,000 into the business." "Oh, well, your balance sheet says 50,000."
Yeah, yeah.
Again,
People
another
don't
issue.
people don't really realize that they need to do that, because the other thing, it looks like you're falsifying records as well, right? When you don't show that the company does owe you money. Can I step back a second? Because I'm listening to you, I know what you're saying, but I'm also trying to put myself in that small business owner's shoes and say, so what is the difference between notice to reader and what are the other levels? Because people hear about audited financial statements and they think, okay, this is where there's the scrutiny of somebody looking at things, making sure everything is perfect. But most small businesses don't do audited. That's when you're a big corporation and you've got shareholders, like external investors, not maybe internal staff investors, but you've got these external investors and you want to make sure you're squeaky clean. So they think large corporation, that's not for me. Is there something in between notice to reader and audited financial statements that we as small business owners should consider when we're doing our financial statements at the end of a year?
I'm going to say that unfortunately, for many small businesses, it doesn't make sense to go beyond notice to reader. There is
Okay.
something called a review engagement, which is an in between. But here is my advice to small business owners is to have the conversation with your accountant and say, listen, I know this is a notice to reader engagement, but I would like to ensure my balance sheet is accurate. And I would like to ensure that these financials are investor ready. They're not just good enough for tax purposes. I'm presenting these to an investor, which would give the accountant a higher level of alert in terms of what they want to be looking for and ensuring accuracy. And this may be a higher level engagement. So the accountant may say, okay, I know I've been used to charging you $2,500 for your tax filing. What you're asking for is going to be $7,500. What's really going to happen is they're going to go open your balance sheet, and it's quite likely that you're going to have old legacy historical items that are still there. If you open your accounts receivable aging report, you may find an AR that is 3 years old that doesn't exist anymore. You might find AP that's 3 years old. You might find a debt that doesn't exist anymore, but it just was left there every year. And this is the process of going through the cleanup of the balance sheet. Now, where you can be proactive and you can actually help yourself is to make sure you understand every line of your balance sheet. Because I find that a lot of business owners understand their profit and loss statement, but they don't even look at their balance sheet. And when you start going through items like what's this prepaid expense, the typical business owner will go, I don't know what that is. So I think you do yourself a service in preparation for financial statements that you're presenting to investors to go through each line item and make sure you understand every line item. And what will likely happen is you're going to say, I don't know why that's still there. That should be taken out. I don't know why that's still there. That should be taken out. And that's likely the result of going through this exercise.
And
Same
I
with the,
think
yeah, sorry.
And I think what that speaks to Daryl is creating a relationship with your accountant. When you first start out, it may look like, Greek to you. You have no idea. Well, Greek to me then, because some people do speak Greek, because you have no idea what all this means. But once you start creating a relationship, they get to know you and your business, and you get to know the questions you need to ask and things that you need to learn. And so to me, it's always a partnership, a relationship with your accountant to make sure you understand your books and you're learning year by year how to run that business from that financial lens, because oftentimes people don't know how to do that.
That's absolutely correct, Hilda. And the other point I'll make about this is that sometimes when we go out and talk to people about why they don't spend money on accounting, they go, well, I can't fathom spending a dollar on something that doesn't generate revenue. Every dollar I spend has to be generating revenue, has to be contributing to business development. And I get that mentality. But when you look at a profit and loss statement, your end goal typically should not be just revenue, it should be profit. It's what you
Mhm.
take home at the end of the year. And there's two line items on a profit and loss statement. There's revenues and there's expenses. So you can do yourself a great service by focusing on your expenses and cutting them as much as possible and ensuring you're not being wasteful on expenses, that effort is actually easier to cut. It's easier to cut expenses than to generate a brand new client. And that way you can generate a lot more profit. And when I meet with a lot of clients and we actually go through the exercise of looking at 1 month of expenses, we often find a lot of wasteful spending. There's, oh, we're still paying for that subscription for that service. Nobody's using that anymore. We should have canceled it last year.
Mhm.
Oh, we've got subscriptions for employees that were terminated 3 years ago. You will find these things just by going through 1 month of,
Yeah,
of a
yeah.
profit and loss statement.
I found it interesting, when my husband and I had our engineering company, I would see all of the invoices. You wear many hats. And and then there are people that start sending you a prescription, but you don't have a prescription for them, right? And so having one person look at these things, especially when it's smaller, you can see that no, you don't need to pay for that. But when you get larger and too many hands are in the pot, you can have duplicate subscriptions. You can have things that I don't know how many people were trying to sell me my domain name. And I would go to my IT guy and says, "Hey, Kevin, um, like this looks like a different company than the other one." She says, "Yeah, it's a scam, Hill. Just throw that away. They're just trying to fish to see if you'll buy, and then you're ending up with a subscription. Now you have two domain subscriptions, and you don't really need them, right?" So,
Mhm.
yeah, you need to do that.
Yeah. And I think that you need to shift the mentality of looking at accounting as a cost center than something that could be a value add. Because if you have a good accounting platform and good accounting people, they can help you with pricing to ensure that you sustain solid gross profit margins. And a gross profit margin is your revenue minus your variable cost for that particular product. Especially in an inflationary environment, you want someone looking at that constantly. And the other thing that we do as well is that we advise clients to, have somebody dedicated at least every 6 months to looking at all your vendors that you currently pay and just going to market and going, what's the current pricing now for this service? If I were to shop and develop a new relationship from scratch, what type of services are they offering and what's the current market price? And often you will find that maybe you're being overcharged by your vendor. And the other thing too to be careful of, and it's just human nature, but when you've been working with a vendor for a very long time, they do get complacent. They start providing a lower level of service over time. It goes on autopilot. They're not doing as much. They're not as proactive as they used to be. And sometimes that fresh blood of bringing in a new vendor who's excited to get your business could revive some of those services. So it is worthwhile because a lot of times, if you use accounting properly, it more than pays for itself.
Now, some people don't see, like some people, meaning some accountants, don't see the extensive kind of research or investigation support that you're sharing with me. Sometimes they just do that notice of to the reader kind of stuff. And I hear your passion, I hear your advocacy,
Mhm.
and your desire to help people keep their costs visible and contained, to cut costs. And what I'm hearing almost is more of a CFO role. So a fractional CFO, meaning you bring in a CFO, it's a chief financial officer part time. That's the term
Mhm.
that gives you that kind of oversight in a more strategic way. Because correct me if I'm wrong, not every accountant thinks to the depth that you're sharing. And I'm hearing this has a fractional CFO mentality and a desire to help small businesses.
Hilda, I will be honest. I think I've come across many people that are very disappointed with their accountants. And when you have an accountant that you've engaged for a notice to reader, again, that false sense of security of, well, that person will tell me if I'm eligible for a grant and probably give me a phone call. The SEBA deadline just passed on January 18th. Did your accountant call you to remind you about the SEBA deadline? A lot of them probably did not.
Mm-hmm.
Um, you know, so you're right that there's a lot of accountants that will just do what they see as their job, which is the bare minimum of making sure that they keep CRA off your back, that you're in compliance for tax purposes, and that's it.
Mm-hmm.
And so, there are other accounting firms out there that are a lot more proactive. and will offer these services. But you're absolutely right. From our perspective, we don't look at financial statements as a product. We look at our advice as a result of the financial statements as a product. Our job as accountants, in my opinion, is to steer companies in the right direction, give them peace of mind that their accounting is being taken care of, and help them make decisions, which doesn't sound like accounting because the accounting people think debits and credits and they think
Mhm,
filing
mhm,
taxes.
mhm, mhm.
So you're right. You do need somebody with more of a CFO mentality that's more collaborative.
Yeah,
And I think it's because I worked in investment banking and I acted as CFO for businesses where I was forced to think more proactively
yeah,
and be involved in every day-to-day decision and understanding all the facets of the business rather than someone who's just spent their entire career in accounting doing taxes and filing.
yeah,
They will
yeah.
not have the same mentality in terms of being collaborative.
Yeah, and I wanted to point that out. And I think, you named your company Vistance,
Yeah.
and you put the word advisory at the back.
Yeah.
And that the advisory tells me that you're not here just to do the the nuts and bolts. You're here as a trusted advisor. I put the trusted in there. But share the how you came to name Vistance, because I found that very interesting.
For sure, Hilda. I actually hired a marketing agency to do a full campaign about 5 years ago when I rebranded. And they actually did focus groups and they talked to entrepreneurs, they talked to my clients, spoke to me, and then they threw up all these stickies on a whiteboard. And they were like, we know what we heard a lot, Daryl. Your client said Daryl sees the big picture. A lot of accountants are narrow focused. Daryl sees the big picture. So they came up with the word Vista. And the other thing they said was Daryl gets me ready. So he's not product focused of here's your financial statement. He's focused on get me ready for my audit, get me ready for my capital raise with investors. It was more goal oriented. So Daryl takes me the distance. So we combine the words vista and distance to come up with the name Vistance, which I was quite happy with. I was very happy with their creativity in putting that together. But really, it's the collaborative approach and the business acumen and understanding that you're dealing with a business owner. You're not dealing with paper and numbers. It's a
Mhm,
real
mhm.
living and breathing business that people need to understand, and I don't think accountants always have an appreciation for that.
Right. I have my own accountant that I've had since our first company, so way back in the 90s. And what I loved about her was she was more than just, as you say, and we always had notice to reader only, but I felt that these were much more intensive than just a notice to reader. And what I loved about her was her philosophy, and I felt in good hands because she was squeaky clean kind of mentality. Not, oh, I can find, this is a little bit gray, but we'll be good. I knew and I wanted integrity. That was one of our values. And I wanted a accountant who also understood we don't want shady gray. We don't even want a little bit gray. We want squeaky clean. And we created the relationship. She taught me over the years more and more how to interpret what I saw. And it was a collaboration of making sure we were financially in good hands. So I sense that too in you, and I want to pull that out from you. So thank you.
Thank you.
Thank you for this. I thought, oh, I think, Daryl will be good for my listeners and my viewers to hear what they need to know. It's not a topic they really like to know about, but they need to know if they want to be able to get um, just bankers and other institutions to fund them, because it's kind of scary. And I think you had some stories about people who, at the very last minute, they didn't make it because of different things. Do you want to share some of those?
For sure. Actually, when I first started my business before the branding of Vistance, I actually started as a capital raising business because my original career path was investment banking. So I started as a one-man consulting firm to really help with business plans, 3 to 5 year financial models, and investor presentations for companies going for Series A equity financing. There's a reason I got into accounting, and it was there were several moments where we were in the due diligence process. We had signed term sheets. We were about to close a capital raise, and then the deal fell apart because of poor financial statements. And they are for the reasons I alluded to before. It was intangible assets not being capitalized. Oh, in your investor presentation, it says you have 300 grand invested in R&D. Why does your balance sheet say zero? Oh, those expenses weren't tracked. Oh, the shareholder loan, you say now you're telling me you're owed $200,000, but your balance sheet says 50,000. The long dated AR/AP aging. You provide them the financial statements. They ask to see your accounting system and what's in there. You send them an AR aging report. They find a receivable that's 3 years old. Then they start to question the credibility of anything that you're sending them.
Mm-hmm.
And it's not, and a lot of times it's not, they don't think you're being facetious. They don't think you're being dishonest. I think there's a recognition that a lot of people just don't have good accounting,
Mm-hmm.
but it does give them a poor first impression of you, where they say, okay, well, you obviously are not looking at your expenses very carefully. There's the broad categorization of expenses. A lot of times you open a profit and loss statement and it's 25% sales and marketing, 25% general administrative. Oh, can you break that down? Well, no, I don't really know the details behind that. Well, then how do you stay lean, right? If you don't know those details. And and when it comes to the categorization as well, sometimes when they do a deep dive, they'll go into office supplies and they'll find SEO costs, which is marketing. It's like, why do you have a marketing cost in office supplies? Oh, well, I didn't know that was an error. So the more errors that you make, it just shows lack of attention to detail
Yeah, yeah,
and lack of care for, and that's not an impression you want to give an investor, because if you think forward, okay, are you going to run out of cash in the future because you're not watching it carefully? Are you going to be bloated in expenses? And are you going to qualify for financing? If you ever need bank financing and you run your company this way, you'll never be able to get debt financing. So that's just a poor first impression that you never want to leave with an investor.
for sure. Any other tips and strategies you want to share to help people really keep their finances, keep
Mhm.
their eye on the finances, as well as present healthy and honest records?
Yeah, I think I'll spend a little bit more time on gross profit margin. When
Yeah.
it comes to profit and loss statement, I'll put a large portion of CEOs in the camp of, I know my top line revenue, I know my bottom line profit, but I don't know much in between.
Hmm.
Now we've talked about the fixed expenses and how important the categorization is, but from a gross profit level, if you want to really entice an investor, a deep understanding of gross profit margin is so important. And you need to know it by product, by service, by different business units, if you have many different business units, because that speaks to scalability. If we know your gross profit margin, you know how quickly your company can scale. Um, and for example, if you're in manufacturing, and one of the questions that obviously will get asked is, well, as you scale your business, do you know how much you can bring your cost of goods or your variable cost down because you're ordering in more volume, as an example? And if you can't answer that question, I think the impression is, well, you haven't thought ahead. And what you want to do when you talk to investors, especially Series A, when you're raising $5 to $10 million, a question in an investor's mind is, I know you're a good starter of a business, and I know you probably know what to do in the next year, but do you know what to do in year two, in year three, in year four? Do you know what to do when you're not no longer 5 employees? You're 10 employees, you're 20 employees, you're 50 employees. And I think that's where a lot of entrepreneurs struggle, is that they're not very good at convincing investors that they're the right person in the right seat when the company grows.
Hmm.
So that's where a fractional CFO can come in as well, where it's like, okay, I recognize that I don't have the experience of running a big business, but I'm going to hire a CFO that's going to guide me so that I know what I need to do moving forward, and that's okay. But there's got to be a recognition, and when you populate your team and your management team, that's got to be a consideration and recognition that somebody needs to know how to run the business from small to medium size. So that's another tip that I would give.
Good. And I would share from my perspective, having grown a company to 125, I know those pinch points. When you get past 10, everybody, like before 10, you could go around when we had offices, we could go around the office and say, "Oh, what are you doing this weekend?" And then on Monday come back, "How was your weekend?" But when you get to 25, there are people now out of the office, in the office, and things that you might have shared. Hey guys, we're going to start this new, process. And you forget that 3 people are missing and they don't get the message. They don't know how to do that. So at a certain point between 10 and 20, you really need to start documenting things. And as you grow, you need to imagine what's it going to be like at 100 people or 75 or 50 people. Is the policy that I'm implementing, is the process that I'm implementing now going to stand the test of time? And is it scalable? I remember when we purchased an integrated software that was going to integrate the ability to identify timesheets, payroll, to put it into a software that would be able to do our invoicing, right, and then get it onto integrating with the accounting bookkeeping system. And I found this software that did all three, and then I started to talk to other people. And when another engineering firm was using it at 200 people and loved it, I knew, okay, we're going to be able to scale. I know if they can do it at 200, we're going to be able to do it when we get to 200. So, you're right. You need to think visionary. And if you, as a small business owner, don't have the ability to vision everything, then hire the right people. Hire a CFO, hire an HR person that's going to help you vision that scaling to that state that you need to grow.
And when we speak about scaling, I think that one of the most difficult things for a CEO who started with 3 or 4 staff to let go of is every day-to-day decision. Um, I find that a lot of CEOs in the startup phase are forced to make every decision, whether it's even like, should we take on this client? Should we extend credit to this client? How big should the contract be? They're used to being involved in every decision, but that's not scalable. And the most difficult thing for a CEO to let go of is a lot of that control. And what we try to do is help our clients so that they are able to create processes and procedures and hire management teams that can be empowered to start making those decisions
Mm-hmm.
so that 80% of day-to-day decisions become automated within management, and maybe only 20% of those decisions that are exceptions float up to the CEO. And one of the tests, and this is obviously later down the line, not right away, but one of the tests when you grow to medium size is, can the CEO go on vacation, step away for 2 months, and the company still run efficiently, right? And that's a
Well, I
great
thought you might say 2 weeks, not 2 months.
yeah, yeah. Well, if a CEO is
Yes, but I
visionary,
understand. Yep.
yeah, if a CEO is visionary, which is what a CEO should be by mid-size, you've got a COO in place that's running operations. A CEO should really not be required for the business to run on its own.
Yep.
They should be thinking of new business ideas, new revenue streams, building new solid partnerships and relationships, corporate culture, vision. I mean, that's what a CEO should be focused on in a medium-sized business. But that's much further down the road.
Mm-hmm. Mm-hmm. No, that I think that's an excellent point of learning how to not feel obligated and need to have every decision come through you. That's a bottleneck, and it's not scalable, and it's actually not good for the health of the CEO, really, because it's too stressful. And to create processes and then to clearly share what they are. So, for example, you might say, yes, you have the authority to purchase things up to $100. Anything over $100 needs to be run by me. And that may be just in expenses. So certain boundaries, $1,000 for certain levels, $5,000 for the next level, but definitely have some boundaries. So great advice. Anything else you want to share before we wrap it up?
Yeah, I mean, now we're talking about looking forward in the future, but um, in my opinion, a company is only as good as its people, right? And it's not necessarily the product or service. It's not necessarily like, yes, of course you have to have an excellent product, and I'm not discounting that, but the people are the most important part of your organization. And if you don't have the right people to execute, you can have the best product in the world, your company will likely fail. So I really believe in hiring the best people, investing in them, investing in their education, investing in their growth, and empowering them to start making decisions so that you don't have to in the future. And bring in people that have critical thinking abilities. And that it's such an undervalued skill, because there are the people that come in and just say, well, tell me what to do. Show me a process checklist and I'll just follow these instructions every day. If your company is run by those people only, there's a limited amount of growth you can have. You need people that can critically think outside the box, step in and go, you know what? I know this is the way that we've been doing things, but it's not the most efficient. I think I've got a better way that I want to try. And some people that are fascinated, curious, and want to constantly improve things, that don't accept the status quo. You need those people in your organization, on your management team as well. So I stress the importance of people, and for companies when it comes to growth.
Of course, what you're saying is just near and dear to my heart, because I really care about creating healthy work cultures, and that's hiring the right people and the fit. But I love this extra piece of advice, is to hire people who are critical thinkers. We used to make sure our team was good, and we want the bright lights, but sometimes people are kind of like the prima donnas, that they feel they're right and they're not team people. But when you have people who are critical thinkers and team people, that's an amazing combination. And I know, as a small business, oh my God, they're climbing. They want more and more, and we may not be able to continue to offer it. So, they're only going to be here for 2 years. I don't think we'll hire them. We'll hire stable guy who's going to be there for 7 years and still do stable guy work in 7 years' time. But think of this. If you hired that bright light who was still a team player, cohesive, imagine what they would have done to change processes, to innovate, to maybe be that corporate glue that says, hey, everybody, we should go out on a social night together or whatever. That person made more of an impression to keep that company moving in a forward-thinking, expansive way than the person who is 7-year guy, really great at what they do, but they're really supporting the growth, supporting the continued growth of the company at this level. That other person, bright light, moved the bar this much further in the 2 years that they came. So you need a mix of both. So thank you for sharing that, and I want to reinforce that to people. What's next for you and your business, Daryl?
Scale, like everybody else. I am looking forward to growing the revenue, obviously, and maintaining a profit margin. For me, it's very important to maintain that profit margin. I judge myself on profit more than revenue,
Mm-hmm.
and ensuring that I make a certain margin on every client. Um, the other thing too that I've been thinking about, obviously in accounting, we are constrained by hours. So there is sort of a bit of a cap in terms of what we can make when it comes to, and it limits the growth ability. I'm always looking at creating a product or service that is scalable. Perhaps it's a software application that helps with cash flow. It's as an example, but we're looking at ideas of implementing a software or something that is a bit more scalable in the accounting world in terms of gaps that we see. And obviously, with the advancement of AI, there's going to be a lot more opportunities for us to look into these things. But that's definitely something that's on our radar.
Okay. Thanks for sharing that. I love that you're telling me you're forward thinking, and people who want to work with you really will have a firm that is always thinking about tomorrow and how we build for tomorrow, how you build to help us grow for tomorrow. How do people get a hold of you?
Well, there's two ways. You can email me. My name is Daryl Ching, so that's Daryl with one R, DARYL. Ching at vistancecapital.com. So basically, it's the word distance, but replace the D with a V as in Victor. So it's VISTANCE capital.com. And we also have our website. It's www.vistancecapital.com. So it's VISTANCE CAPITAL.com.
Great, thank you. And I like how you remembered that. For those of you who are listening, you're not going to see what is flashing on the screen of how to get a hold of him. So thank you for sharing that, because people do spell things different ways. And so great. Wonderful to have you. For you to share your knowledge in helping us, because I think for many people, finance is not their strength, but they need to know enough to continue to make sure that they're growing their business and their profit and keeping a good eye on their expenses. So thank you again for joining me today, Daryl.
You're welcome, Hilda. Absolutely. I tell business owners, focus on what you're good at, your unique abilities. That's what you want to focus on in running your business, and let somebody else handle the accounting and the work that maybe you're not so strong at.
Thank you. I totally agree with you. Find your strengths and do them and love doing them. But where you need help, seek the advice of people who can do it and do it well for you. Thanks again. And to those who are listening and viewing, thank you for joining us. If you like us, give us a thumbs up, a subscribe to Rev Up Your Business. Thanks for joining us. Thank you for tuning in to Rev Up Your Business with Hilda Gann. Be sure to like, comment, and subscribe to our podcast on YouTube and Spotify to stay up to date with all of our latest episodes. For more HR tips, strategies, and to learn how you can create a people-centric workplace, visit our website at peoplebrightconsulting.com.